Hey, Dan Passarelli here. Well, today was a pretty darn wild day in the stock market. We were down a bit earlier, I want to say around 1%. And then we were up about 2% and we closed up just about 1%. We had a fair amount of movement today. And of course, that was because of the Fed announcement where the Federal Reserve Committee decided to raise interest rates 25 basis points, pretty much as expected. But if you've been following news on the economy and what's coming out of the Fed and what some reporters are saying, if you're not confused, you should be confused by the Fed news and lots of other news. So let's take a look at some stories that came out after the Fed cut rates. So Federal Reserve downshifts to 25 basis points. The pace of interest rate hikes slows with inflation. So inflation slowed a small amount through the last couple of numbers we had, and we're significantly cutting the pace of interest rates. Okay, that's fine. Doesn't exactly match up on a one-to-one basis here, but let's keep reading. There's a path to getting inflation to 2% without significant economic decline. So I think what he's talking about there is the good old immaculate disinflation, where we're raising interest rates so that we can weaken the economy so that inflation slows down, trying to basically land a Boeing 737 on a dime. And, you know me from watching my videos, I don't like to be a hater in any way, but in order to understand what's going on, we've got to kind of sort through some of the BS, right? Let's look at another headline here. So this is a good one. And this is all from Powell's speech, by the way. We're not very far. We're not very far from that level. Says real rates are now positive across the yield curve. What positive across the yield curve means is that the market is expecting interest rates to rise, not to fall at a lower rate, not to stay the same, but actually to rise going out in the future. So the Fed is citing that interest rates are expected to rise in the future, but still considering cutting interest rates going forward. Now, by the way, I don't have any more of a horse in this race than anyone else. I'm not necessarily trying to armchair quarterback what the Fed should or shouldn't do. I'm just pointing out that given this Fed news, if you're not confused, you really ought to be. Fed Powell says we're talking about a couple more rate hikes to get to appropriately restrictive stance. And you pair these last two comments together, and man, oh man, is that confusing. Now, I also prepared just a couple of things here. We see this in the media as well. Traders piling into the rally, and this is just, these were all within the last few days. Traders piling into the rally in equities are forgetting the cardinal rule of investing: don't fight the Fed. That's according to Morgan Stanley strategist, who says the move in stocks is more driven by seasonal factors than any compelling narrative and is in direct defiance to the Federal Reserve. So he's talking about the up move not being in tune with reality. The Q4 earnings season for the S&P 500 continues to be subpar. While the number of S&P 500 companies reporting positive earnings surprises increased over the past week, the magnitude of those earnings surprises decreased during these times, both metrics below their 5 and 10-year averages. And then we have the IMF coming out and saying it's raising its global economic outlook for the first time in a year, with GDP set to expand. At least here we have someone pointing out the contrast between news out of the tech industry and its performance in the market, and how it could not be starker, despite these companies issuing a wave of mass layoffs, recession warnings, and grim earnings results. The tech-focused NASDAQ is on pace to record its best January since 1999. Investors are too busy drooling over the prospect of the Fed slowing down its rate hikes. So, look, I've been in trading, specifically option trading, for 30 years now. One thing that I know is that traders can be impulsive and they have short-term memories. And so when we try and look at the big picture, I think it's important to be a little bit cautious getting too aggressive going into some of these rallies like we saw today. I wouldn't be surprised if we see a pullback following this, and there might be some selling opportunities, some hedging opportunities, some covered call opportunities, and some call credit spread opportunities presenting themselves right now at this time. Now, again, I'm not trying to be alarmist, and the market has certainly surprised me in the past and will do so again in the future. But when we really take in the news and we really look beyond some of the rhetoric and what some people are saying, and we look at what folks from Morgan Stanley are saying and some experts on earnings and some of the other people who manage large amounts of money, most of them are not bullish on the market. So I want you to take that with a grain of salt and think about that sort of in your own words, put your own work into it, but be cautious out there. And there's a lot of BS to sort through. It's important as a trader and as an investor to do so. This is Dan Passarelli. I hope that helps. Trade smart.